Welcome, and thank you for joining this talk on understanding tax implications when investing in funds of funds, presented by Dr. Microlearning. Over the next few minutes, we will unpack how fund of funds structures affect investor taxes, timing, and liquidity, and highlight practical strategies to protect after-tax returns while staying compliant with K1 reporting realities. This slide highlights the main drivers of taxable events inside a fund of funds. Capital calls, management fees, carried interest, in-kind distributions, and reinvestments can all trigger tax consequences. The diagram shows how multiple events flow into different income characterizations: short-term, long-term, ordinary income or capital gains, so proactive planning around timing, anticipated Kone second, and compliance is essential to manage personal tax liability. Here we trace the K1 flow from underlying partnerships through the fund of funds to the final investor K1, illustrating how multiple partnership Kone second are consolidated and relabeled at the FOF layer. The key point is that income generally retains its original character, but receipt can be delayed and aggregated, so investors should expect postponed tax reporting and plan cash flows accordingly. This visual explains phantom income and related liquidity challenges, showing how allocated profits can create taxable income without corresponding cash. Tax distribution clauses offer partial relief by creating cash distributions meant to cover tax, while clawback provisions can produce a liquidity mismatch when tax liabilities exceed available cash. The takeaway is to anticipate potential gaps and maintain reserves or contingency plans. The chart warns about non-qualified income sources, like REITs, futures, high-yield bonds, and MLPs, that often flow through a FOF and are taxed at ordinary rates. The pass-through effect can amplify tax exposure, potentially triggering the 3.8% Medicare surtax and higher marginal tax burdens. So structure and asset selection matter greatly for after-tax outcomes, especially for high-earning investors. This slide shows how active trading by sub-advisors can generate short-term capital gains inside a FOF, which ultimately appear on investor statements and are taxed as ordinary income. Even when an investor follows a buy-and-hold strategy at the FOF level, underlying trading can create a large slice of ordinary rate gains, so monitoring sub-advisor activity and managing turnover is crucial to limit tax drag. The comparison highlights a tax efficiency advantage of an ETF wrapper versus a mutual fund wrapper. ETFs can deliver securities in a kind to redeeming shareholders, avoiding forced sales and capital gain distributions, whereas mutual funds typically use cash redemptions that can trigger realized gains. The practical conclusion is that ETF wrappers often enhance after-tax returns by minimizing forced taxable events. This slide outlines a 5-step pre-commitment tax due diligence framework. Request historical K1 breakouts to analyze income character, estimate an effective tax cost ratio, verify the fund's taxi distribution policy, check UBTI exposure for taxi-exempt investors, and model multi-year after-tax IRR scenarios. The objective is simple: perform comprehensive diligence so the strategy's alpha isn't eroded by the tax layer. Here are actionable, investor-facing tactics to optimize returns and compliance in a FOF context. Align estimated tax payments with expected K1 delays to avoid underpayment penalties. Harvest losses externally to offset FOF gains. Evaluate whether distributions in cash or in-kind affect timing and basis, and document clawback contingencies while keeping sufficient liquidity reserves and detailed records for future reversals.